Next concept, tracking error. Tracking error can be defined as divergence or deviation of the fund's return from the benchmark return it is following. The passive fund managers closely follow or track the benchmark index. Although they design their investment strategy on the same index, but often it may not exactly replicate the index return. In such situation, there is a possibility of the deviation between the returns. Tracking error can be calculated on the basis of the corresponding benchmark return vis-a-vis quarterly or monthly averages NAV. Higher the tracking error, higher is the risk profile of the fund. Whether the fund outperform or underperform their benchmark indices, it clearly indicates that the fund managers are not following the benchmark indices properly. In addition to, some other reason for the tracking error are as follows. 1. Transaction cost. Second, fees charged by the AMC. Third, fund management expenses. Fourth, cash holding. Fifth, sampling biases. Thus, from the above, it can be said that to replicate the returns to any benchmark index, the tracking error should be near to zero. The tracking error is calculated using the following formula. It is D, that is differential return, minus D bar, that is average of the differential return, divided by number of observations minus 1 and under root of the same. This is a tracking error. Let us have again understanding of the same, say by a small example like this. Dear students, what happens that, let us say that there is a mutual fund A which is formed, and mutual fund A has told to the investor that say we are not going to do anything else, but we are going to replicate, let us say, Nifty 50. If you are expecting the Nifty 50 to go up, then in that case you make investment with us. So we are not going to do anything else than like absolutely replicating the Nifty 50 in our portfolio. Now let us say that, say it happens like this. 1, 2, 3, 4, 5. In last 5 years, the return of the mutual fund A is, let us say, 12%, negative 6%, 8%, 13%, and let us say 9%. And Nifty 50 had a return as, let us say, 12.5%, negative 7%, then 9.5%, 12%, and 9.5%. Means, so the return of this mutual fund is not exactly the same as the return of the Nifty 50. Okay, so this is what we understand is, say there is a difference. So standard deviation of this differential return is considered to be the tracking error. So how it is calculated, I just tell you. First of all, we compute the D, that is difference. So 12 minus 12.5, so it is negative 0.5. Minus 6 minus 7 is 1. 8 minus 9.5 is negative 1.5. 13 minus 12 is 1. 9 minus 9.5, it is negative 0.5. We'll make the summation of the same. So summation D, then we compute the D bar, that is over here, it is 0.5 negative plus 1 negative 1.5 minus 0.5, so it is negative 1.5. It is over the time period of 5 years, so divide by 5, that comes to negative 0.3%. Then we make the computation of the D minus D bar, then D minus D bar whole square, summation of the same divided by n minus 1 is variance, and then under root of the same is standard deviation. This is the way the tracking error is calculated. Now, why there is tracking error? In a way that say why the mutual fund is not able to generate exactly the return as Nifty 50, even though it had given that commitment, and even though say it is having say the same portfolio say as Nifty 50. Same replicating portfolio means whatever the securities are there, same securities are there in my portfolio. Whatever the proportion is there, same is the proportion of my portfolio. Even though the returns are not same. Why is it like this? For that the reasons are like this. The first important is the transaction cost. Friends, as far as the Nifty 50 index value is concerned, that value is calculated simply by taking into account say those securities free float market capitalization, and with that say we make the computation of the Nifty 50 value. So actually there is no purchase of the security, actually there is no sale of the security, but this mutual fund is required to actually do all these transactions. You have to buy Reliance, you have to sell Reliance, you have to buy HDFC, you have to sell HDFC, and so on. So this mutual fund is basically required to do all those transactions, and because of that, of course its return would be lesser in comparison to the Nifty 50. So this is the first valid acceptable reason. The second is fees charged by the asset management company. Basically friends, as we understand that there are two types of portfolio. One is active portfolio and another is passive portfolio. This is an example of the passive portfolio wherein you don't have to make the economic analysis, you don't have to make the industry analysis, you don't have to make the company analysis, you don't have to do all these things. You just have to replicate the portfolio. But for that, of course, there are administration charges which the AMC is going to charge. There will be, of course, a fund manager who will be tracking that portfolio at least when the internal proportion will change. Because the number of securities are fixed, but the internal proportion will change. In case of BSE 500, there are 500 companies. So maintaining the individual proportion of all of them would definitely require some administration, and for that the fees will be charged by the AMC, and with that of course the return of that fund will be lower in comparison to the Nifty, that is the index, and because of that there is a tracking error. Fund expenses, we understand that there are two things. One is a trust, that is the mutual fund, and another is the AMC, asset management company. Asset management company is charging for managing the portfolio, and the fund is having formed in form of the trust will have certain its own at least some administration expenses. It will not be charging for the managing the portfolio, but as a trust it is supposed to be formed and certain expenses are there. So the fund expenses which is charged by the mutual fund, in a way that the trust is having certain expenses, and because of that the return of the fund will be lesser in comparison to the index. Cash holding. Now friends, what happens at let us say that there is a fund which has an amount of, in a way that there is that is a mutual fund which is following Nifty 50. Okay, now let us say that the fund has the asset under management of an amount of rupees 5 crore, okay, very less amount, and say it is receiving an amount of 10,000 rupees from the investor. Now that 10,000 rupees may not be invested in that 50 securities proportionately. So you are required to hold some amount of the cash. So again what will happen, from your total portfolio certain amount is kept in form of cash, and it is not invested in the fund, not invested in the securities. Now what happens at suppose the Nifty 50 is going up. Now the proportion in which the Nifty 50 is going up, in that proportion your entire assets will not go up. Why? Because certain portion is held in form of cash. Reverse, if at all that the Nifty 50 is going down, then in that case the net assets of your fund will go down, but it not in the same proportion. That is per se we understand is the cash holding. So it may have the positive effect or it may have the negative effect. Second important thing that we understand is, let's say for day-to-day expenses you hold certain amount of the cash. For the purpose of the redemption, say you are holding some amount of the cash. So majority of your portfolio is invested, but that certain portion is not invested. And because of that certain portion, you will not be able to generate exactly the same return as the indices. But it may have the positive effect, it may have the negative effect. These three will always have the negative effect. In a way that the mutual fund performance is going to be lower in comparison to the index. Sampling, that is the biasness. Sampling biasness is, we understand that say BSE 500, in that 500 securities are there. So in that also some sampling biases that say you may have. So let us read it once again, friends. Tracking error can be defined as a diversion or deviation of the fund's return from the benchmark return it is following. Okay. So your return in comparison to the benchmark may be Nifty 20, Nifty 50, BSE 20, BSE 50, BSE 500, anything. So diversion means the difference. The passive fund managers, why it is called passive? Because you don't have to use your mind the way active managers are using. Closely follow or track the benchmark index. Although they design their investment strategy on the same index, but often it may not exactly replicate the index return. So they are not able to replicate the index return. In such situation, there is a possibility of the deviation between the returns. The tracking error can be calculated on the basis of the corresponding benchmark return vis-a-vis the quarterly or monthly average NAVs. We understand that the change in the NAV is the way the return is calculated. Higher the tracking error, higher is the risk profile of the fund. So higher the tracking error is not considered to be a good sign. It shows that you are not able to exactly replicate in the portfolio. Whenever the fund outperform or underperform their benchmark indices, it clearly indicates that fund managers are not following the benchmark indices properly. So you may be outperforming it, yet in that case it is not considered to be a good sign. Because basically you had given commitment to the investor that I will follow the index. Fortunately this time you are able to outperform, but it may happen that you are underperforming. Then in that case, an investor were very clear that we want to follow the index only. In addition to the same, other reason for the tracking error are as follows. Friends, in July 2021 examination, there was a theory question from the TAC, that is there was a theory question from the mutual fund chapter, and that was a tracking error. One is the transaction cost which mutual fund is required to bear, and not the Nifty 50 or any other indices, because it is simply the calculation of the weighted average value of the indices, and in that there is no cost required to be incurred for purchasing and selling of the securities. Fees charged by the asset management companies, that is the experts, own expenses of the fund, that is of the trust, cash holding, because genuinely the fund is required to maintain a certain amount in form of cash for different reasons. One is day-to-day expenses, another is for redemption. Next is that you may not be able to track the index, because the amount that you have received is very low in comparison to the number of securities in which you have to make investment. Because you can just imagine that there are 50 stocks, and whatever the amount that you receive, then you have to proportionately allocate. Sampling biases. From the above, it can be said that to replicate means you don't have to, that is, use your mind. The return to any benchmark index, the tracking error should be near to zero. So lower that is the tracking error is good. Tracking error is calculated as follows. So D stands for differential return, which I have explained you how to calculate. D bar is like average of the differential return. That is the simple mean calculation that we do. So D minus D bar, you make square of the same, then you make summation divided by n minus 1 is the variance, and its under root is what we understand is the standard deviation. Exactly the same thing so that you do in the portfolio management. The reason that say we do n minus 1 over here is because of the statistical reason of the sample data for analysis and population data for analysis. As far as the sample data is concerned, sample data means that suppose I want to estimate the return of the Infosys which I will be getting in the next year. In that case, the Infosys was formed before 30 years. I may, if at all I take all 30 years return, it is the population data. And if at all I take the recent 5-7 years return, then it is sample data. N is the number of observations. That is 5 years you have taken, 10 years you have taken, something like that. That is the way you are required to consider it. So over here friends, you will make the calculation further like this. D minus D bar. So in that case it is negative 0.5 minus negative 0.3. That is negative 0.2. Then 1 minus negative 0.3 is 1.3 positive. 1.5 negative minus 0.3 negative is negative 1.2. 1 minus negative 0.3 is again 1.3 positive. 0.5 negative minus 0.3 negative is negative 0.20. Then D minus D bar whole square. To eliminate the effect of the negative, so square of 0.2, that is 0.04. Square of 1.3, that is 1.69. Square of 1.2 negative, that is 1.44, and of course it will become positive. Then 1.69, then 0.04. So the total is 4.90. There is a small calculation error over here in calculation of summation D. Okay. So accordingly, we understand that say we are required to adjust the values. Then we understand that say it is 4.90 divided by 5 minus 1. Okay. Just be careful because the formula is very clear. D minus D bar whole square divided by n minus 1. And its under root. So it is 4.9 minus 4, sorry, 4.9 divided by 4, that comes to 1.225 and under root of the same. So it is 1.1068. That is the way the tracking error is calculated, and it should be low so far possible. That is what we understand. If you have, then open your May 19 RTP, question number 14A. So question number 14A, it is revisionary test paper of May 2019. Explain the concept of side pocketing in a mutual fund. So exactly the same thing that say they have provided over here, which we have recently gone through. November 19 revisionary test paper. In that question number 14a, explain briefly the concept of exchange traded funds. Exchange traded funds were introduced in United States in 1993 and came to India around 2002. Exchange traded fund means the fund which is say traded through exchange is hybrid product that combines features of index future fund and stock, and hence it is called index shares. These funds are listed on the stock exchange similar to the shares, and their prices are linked to the underlying index. The authorized participants act as the market makers of the exchange funds. Market makers means those who can enter into the transactions. Exchange traded funds can be bought and sold like any other stock on stock exchange. In other words, they can be bought or they can be sold anytime during the market hours at prices that are expected to close to the NAV at the end of the day. Net asset value of an ETF is the value of the underlying component of the benchmark index held by the ETF plus accrued dividend less accrued management fees. There is no paperwork involved for investing in an ETF. This can be bought like any other stock by just placing an order with a broker. Some other important features are as follows. It gives an investors the benefit of investing in a commodity without physically purchasing the commodity like gold, like silver, like sugar, etc. And if at all I am expecting say some the metal product to go up, I may make investment through ETF. It is launched by an asset management company or other entity. The investor does not need to physically store the commodity or bear the cost of upkeep, which is part of the administration of the fund. An ETF combines the valuation features of the mutual fund or the unit investment trust, which can be bought or sold at the end of each trading day for its net asset value, with the tradability feature of close-ended fund, which trades throughout the trading day at prices that may be more or less than its NAV. So let us refer a question asked in November 2020 examination. Question number 4C. Side pocketing enhances the value of the mutual fund. Do you agree? Yes, we agree. Briefly explain the process of the side pocketing. Yes, side pocketing enhances the value of the mutual fund. In simple words, side pocketing of the mutual fund leads to separation of the risky assets from other investments and the cash holding. The purpose is to make sure that the money invested in the mutual fund, which is linked to stressed asset, gets locked until the fund recovers money from the company or could avoid distressed selling of the illiquid securities. Process. The modus operating is simple. Whenever the rating of the mutual fund decreases and so on, it is exactly the same thing that say we have read. The next question is, let us say July 2021, question number 6C. In that say there were two questions. So the or question was describe tracking error, list the reasons for it. So we are required to mention entire working of the tracking error and along with that its reason. So this is what say you are required to mention, and of course friends, you need to be very clear that say these are the only reasons that say you are required to mention and say not anything else. This is what we understand. So let us write the answer of the tracking error. I just rectify the answer because there is some mistake over here. So write down heading calculate tracking error from following information. Year 1, 2, 3, 4, 5. Mutual fund A return and Nifty return. Or whatever may be the other benchmark for which of course information will be given to us. 12, negative 6, 8, 13 and 9. Nifty return is 12.5, negative 7, 9.5, 12 and 9.5 once again. So write down answer. Calculation of tracking error. So in that, friends, what we will do, return of the mutual fund A minus return of the Nifty will compute difference of both of them, and that is what we understand is the differential return. So 12 minus 12.5 is negative 0.5, minus 7 minus 6 minus 7 is negative 1, sorry, positive 1, 8 minus 9.5 is negative 1.5, 13 minus 12 is 1 positive, 9 minus 9.5 is negative 0.5. So the total for that is negative 0.5. So summation of D is negative 0.5. So D bar, it is summation D divided by N. Negative 0.5 percentage divided by 5. That is negative 0.10 percentage. Because over here, friends, we have to take N in the division, that is the number of years. Then D minus D bar. So over here it is 0.50 negative minus 0.10 negative. So it is negative 0.40. 1 minus negative 0.5. I'm sorry. 1 minus negative 0.10, that is 1.1 positive. Then 1.5 negative minus 0.10 negative is 1.4 negative. 1 minus negative 0.10 is 1.1. 0.5 negative minus 0.1 is 0.4 negative. That is the way D minus D bar is found. So D minus D bar square. So negative 0.4 square is 0.16. Square of 1.1 is 1.21. Square of 1.4 is 1.96. Square of 1.1 is 1.21. Square of 0.4 is 0.16. And we'll make the total. This is the summation D minus D bar whole square. And its summation is 4.70. 0.16 plus 1.21 plus 1.96, 1.21 plus 0.16. So 4.70. So now we'll make the computation of the standard deviation directly. Standard deviation is calculated as root of the variance. So the variance is calculated as summation of d minus d bar whole square divided by n minus 1, because it is the sample data for assessment. So over here the institute has given formula wherein they have considered that, say, we are having the sample data for assessment and not the population data. So over here it is d minus d bar whole square and summation of that is 4.70 divided by 5 minus 1, it's under root. So 4.7 upon 4, that is 1.175. So under root of 1.175, that is 1.0839 percentage. Friends, just one thing that I want to tell you is further, we already have done something like this. Friends, we already have studied a point in value at risk, that suppose the 1 year variance is 625, suppose, then 1 year standard deviation is 25. If at all the 1 year variance is 625, then half year variance is 312.5. However, the half year standard deviation is not 25 divided by 2. It is required to be calculated as whatever the standard deviation 25 into under root of the time period. That is the way we are supposed to make the calculation of the standard deviation for half year. So same is the case applicable over here. In case you have been provided with the information of the returns instead of like yearly, and so you have been provided with the monthly rate, that is return information, or quarterly return information, then in that case you are required to see whether the question is about the monthly return, quarterly return, half yearly return, something like that. If yes, then in that case, in order to compute, that is say compute the annualized standard deviation, you are required to take help of say this formula. This is the way you are required to say make the computation of the standard deviation in annualized term.